Good afternoon, everyone. Welcome to our webinar on our third Heterogeneity blog series. Today's series is focused on credit market outcomes. On the panel today are Andy Howitt, Joelle Scally, Hao-Young Liu, Raji Chakrabarty, Maxim Pekomsky, Wilbert Vanderklau, and Dong-Hoon Lee. Andy will give opening remarks, followed by a presentation from our economists, and then we'll open it up for Q&A. We ask that you please hold your questions until the end of the presentations. And with that, I will turn it over to Andy Howitt. Thank you.
Thanks, Andrea. Welcome all, and thanks for joining today's event. It's focused on our third economic inequality blog series in the last 9 months. The first 2 series, published last October and in early March, comprised 10 separate posts that analyzed inequality and outcomes ranging from life expectancy to the benefits of a college education to job satisfaction. Of course, even as we were discussing the labor market inequality in March, the world was changing radically with the onset of the COVID-19 pandemic. As a result, the bank's economists, including those here today, shifted their efforts to analyzing the effects of the pandemic on all aspects of the economy and all segments of the society. Much of that work is in the public domain. You can see it in the form of monetary policy announcements and the creation of new facilities intended to ensure that credit continues to flow to households, small businesses, and state and local governments. You can also see quite a bit of it in the form of Liberty Street economic law. The authors you will hear from today have contributed heavily to this COVID-related work, as have many others. Olivier Armentier and Gizem Kosar, for example, contributed to work on how the pandemic is affecting different people's expectations of the future on issues ranging from their likelihood to hold on to their job to overall inflation. Or Laura Pilosov's work on the racial and income profiles of workers who can or cannot work from home. In all, there have been over 40 blog posts on COVID since the pandemic began, and there will be many more to come. The issues we'll discuss today are longer term, in some sense deeper disparities in the economy. Today's subjects include disparities in access to housing, education, and healthcare, and their impact on household finances. These are critical social issues that long predate COVID, but it's clear that the implications of each have been made even starker by the pandemic and the associated economic crisis. In that sense, today's material is closely related to the pandemic, even if the blogs themselves don't use the word COVID very much. The many things I've described here and what we'll discuss today are just the beginning. We have plans for lots of additional analyses on questions ranging from identifying the beneficiaries of the CARES Act to understanding how reopening and job recalls affect different groups. So I'll close by pointing out that all of the work I've described here fits comfortably within the mandate of the Federal Reserve. It's our mission to make the economy stronger, and that means keeping everyone engaged in the labor market. It also involves special attention to the outlook for the most vulnerable and those most affected by economic dislocation. I can assure you that discussions of the way the crisis is affecting different sectors, different places, and different people are central to our work in all its forms. So thank you all again for being here. I look forward to continued discussion of these topics. And with that, I'll turn it over to Joelle Scally, who will get us started with an overview of our first blog.
Hi, all. Thank you so much for that introduction, Andy, and thank you all for being here. I hope everyone can hear me. I will be speaking about our blog post, Inequality in U.S. Homeownership Rates by Race and Ethnicity, which is work done together with Andy, as well as Dong-Hoon Lee and Wilbert Vanderklau. Now, we're looking at homeownership because it has historically been an important tool for Americans to acquire wealth. Now, I'll start here by showing you these 2 charts side by side. Of the homeownership rates by race. You can see first that homeownership rates have been historically much higher among white households compared to Black and Hispanic households. so much that we had to use two different scalings on these axes for these two charts. Now, income differences and institutional racism, that is legal explicit discrimination in housing, including redlining, which endured through 1968, have contributed to these huge gaps. But the purpose of this post was actually to explore what's been happening in the past few years. The Black-white and the Black-Hispanic homeownership gaps have actually widened since 2015. With the Black-white homeownership gap has averaged about 31% in the past few years. So moving on to the first piece of the analysis, which was really to understand the dynamics behind the changes in the homeownership rate, to sort of decompose them in a way. Now, from here on, we're using data from our consumer credit panel, which is based on Equifax credit reports. Now, one thing to note, of course, is that we don't have race on credit reports. That's protected. It's a protected protected variable in lending. So instead, we're using the borrower's zip codes, and we classify zip codes by the race of the majority of residents in each zip code. Now, back to homeownership, rates can go up because of an increase in first-time homeowners, or it can decline because people exit homeownership, most typically through foreclosure in the past 10 or so years. So I'm going to start here with homeownership exits on the left. Now, here you can see that in Black majority zip codes, the foreclosure rates were actually higher during the Great Recession. They were the highest among Hispanic majority zip codes, and this is in part because Hispanic majority zip codes were concentrated in states that were hardest hit during the Great Recession. But in the years since, the Black majority zip codes have had the highest foreclosure rates, and they've been exiting homeownership at a higher rate through foreclosure, at least, compared to the white majority and Hispanic majority areas. Now, moving on to entry into homeownership, on the right side, we look at the share of mortgage holders who are new entrants. And what you can see is that although entry into homeownership was quite high among Black and Hispanic households, in Black and Hispanic majority areas during the housing boom years before the Great Recession, in the years since, the entry into homeownership, that is the share of mortgage holders that are new mortgagers in Black majority areas, has been the lowest compared to white and Hispanic majority areas. So what this means is that a higher exit rate paired with the lower entry rate mean that the homeownership rate among Black households has just not recovered at the same rate as in others. Now, moving on to the next piece of this blog, we examined some potential explanations for the growing homeownership gap. We're still using our consumer credit panel here, but the first potential thing that we explore is the fact that mortgage underwriting has been pretty tight. It's much harder to get a mortgage since 2010. Mortgage underwriting has just been very tight since the Great Recession. Now, the 10th percentile of credit scores of newly originated mortgages, which we'll interpret here as the sort of minimum credit score required for a mortgage, has been around 650 for some time. But when we look at the average credit score in Black majority areas, it's just below this at 638. So the average resident of these areas is actually not even going to be able to qualify for a mortgage right now. By contrast, the average credit score in majority Hispanic and white areas are 679 and 716 respectively. So just a little bit higher. The next potential explanation that we explore is that there have been differential labor market experiences since the Great Recession. Now, we know that Black workers fared much worse during the Great Recession and had a very high unemployment rate. But, at the beginning of 2020, at least before the pandemic started, their unemployment rate was quite low. But we do see that they had a much more stagnant wage growth compared to white and Hispanic workers in the years since. That is, since 2012. So that may be one factor that had contributed to that lower entry into homeownership rate. And then finally, we explore student loans. Now, we had a blog post back in November of 2019 where we explored this in great detail. And what we found was that the participation rates among Black and Hispanic students were very comparable to those among white of white students, and the balances actually aren't very different in these three areas. But when you consider that there are very different income levels, the suggested debt-to-income ratio of the average borrower is very high in the average Black and Hispanic area. Further, the default rates in majority Black areas are much higher. They're almost double that of the majority white areas. Now, having a defaulted student loan on your credit report alone would make it very difficult to qualify for a mortgage. Now, to conclude, these growing gaps in homeownership are really important, and they may have longer-term implications for wealth accumulation and inequality. Further, one important component to the relief to Americans through the CARES Act was through forbearances on mortgages. So the unequal homeownership rates have real implications for the availability and distribution of relief through that channel. So that's it for me. Thank you, and I will turn this over to Hao Young.
Thank you, Joelle. Thanks everyone for coming. This is joint work with our colleague Andy and Xiaohan from Cal State LA. So we study the causes and consequences of evictions. So there are a couple of reasons why we care about evictions. More than 2 million American households face the risk of evictions every year. And now with 4 months into the COVID-19 outbreak, there's also a risk of a large wave of evictions in the second half of this year, now that many of the eviction moratoria have been lifted. Also, evictions have been suggested to cause reduced credit access, housing instability, and worsened health outcomes. So to study these issues, we fielded an eviction survey within the housing module of the New York Fed Survey of Consumer Expectations. And I would note that our survey was fielded in February, so largely before the COVID-19 outbreak. So they're more about some long-term facts about evictions than about like some shorter dynamics. So this is the first chart that I'm going to show you. So it's about evictions and income. On the x-axis, what we have here is income. So income ranges from $5,000 to $250,000. And on the y-axis, I'm showing you two curves. The blue curve is the percentage of households who know someone evicted in the past. And the red curve is the percentage of households who have been evicted themselves. So what you can see here is there is a strong relationship between income and evictions. As income goes up, the chances of being evicted or knowing someone evicted go down. Also, this relationship is highly nonlinear. So in fact, over 75% of the evictions happen to households with a current income under $50,000 a year. Once a household's income is above $50,000, the chance of eviction is very low. So the relationship is highly nonlinear. So we also study reasons for evictions. Income or job loss is the most common reason for evictions. They account for roughly slightly over 1/2 of the evictions in our sample. For evictions without a negative income shock, there's another 10-15% of the evictions driven by change of building ownership. That is, the owner sells the property to a new owner, remodeling, or the landlord converts the rental property back to a primary residence. So in fact, for evictions for households who did not suffer an income loss, change of building ownership is the most common reason for evictions. This results motivate recent state and local policies trying to regulate no-fault evictions. So renters sometimes can get evicted even when they pay rent on time and when they maintain their property. So many state and local governments try to regulate such no-fault evictions. This is a large chart that I'm going to show you. So it's about credit access. So here we separate households in our sample into 4 groups: current renters with a past eviction, current renter without past eviction, current homeowners with a past eviction, and current homeowners without a past eviction. The left panel shows the percentage of households with a credit card, currently with a credit card. And the right panel shows you the percentage of households having applied for credit cards over the past 12 months. So what we can see here is renters with a past eviction, so represented by the blue bar. Looking at the right panels, despite applying for credit cards more often than the other households, and they are much less likely to have a credit card, looking from the left panel. So evictions are indeed linked to reduced credit access. So in summary, we show that evictions are highly concentrated in low-income households income loss is the most common reason for evictions, followed by change of dual ownership, and evictions are linked to reduced credit access. With that, I will turn to Raji.
Thanks, Wong. So we are going to move from the housing market now to education market and student debt market. I'm going to actually talk about two posts back to back. The first one would relate to the education and student debt market. The second one is going to relate to education market, student debt market, as well as other credit markets. Both these posts are co-authored with Will Nober and Wilbert van der Klauw. The first post is going to look at racial disparities in higher education and student debt outcomes. So let's first move to look at heterogeneities by college attendance. So in this chart, we are using the same definition as Joel did in the first post that she presented. We are, as Joel alluded to, we really don't see race or income in our consumer credit panel. And these two posts will also use data from the consumer credit panel, which is matched to education data from the National Student Clearinghouse. So in this post, we will do the same as Joel did in the first post. We are going to look at neighborhoods or zip codes and the racial composition of neighborhoods. And we're going to define white majority, where at least half of the residents are non-Hispanic white. And similarly, we are going to define majority Black and majority Hispanic neighborhoods. So if you look at the attendance rate, the overall attendance rates, which is being graphed by age 30, you see that there are disparities between individuals coming from these three different types of neighborhoods. We can see here this college attendance rates is highest for individuals coming from white majority areas, and it's the lowest for individuals coming from Hispanic majority areas. There are actually differences if we look at 2-year versus 4-year college attendance. We see that most of this difference comes from differences in 4-year college attendance rates. In fact, we see here that the 4-year college attendance rates for individuals from Hispanic neighborhoods is the lowest, and it's the highest for individuals from majority white neighborhoods. It is worth noting at this point that typically if you look at labor market outcomes, there is a distinction between outcomes for students coming from 2-year or 4-year colleges. It is typically the case that 4-year college students have much better outcomes. Now let's move on to student debt borrowing. So we are going to look at student debt borrowing. Once again, we are going to distinguish between these three different areas. What we see here, if we look at the bars, once again, we are going to denote 2-year colleges by the blue bar and the 4-year ones with the red bar. We see that students from majority Black areas are considerably more likely to borrow. And that is also true for both 2-year attendees as well as 4-year attendees. So the borrowing rate, first of all, is higher for 4-year attendees overall across the board. And that makes sense because 4-year tuition rates, 4-year college tuition rates are considerably higher. The 2-year college tuition rates are about 2.5K. The 4 years are close to, if public colleges, they're about 6K, considerably higher for private not-for-profit. And we see here that accordingly, the 4-year propensity to borrow is considerably higher. And this again is considerably higher for individuals coming from the majority Black areas. So next, let's move on to default rates for individuals coming from these three different types of neighborhoods. So what we can see here is that while it was the case in the previous slide that the propensity to borrow is higher for 4-year college students, here we see there is a flip. We see that actually 2-year college borrowers are more likely to default. And that to some extent is because of the differences in labor market outcomes that they have, which makes it difficult for them to pay back student debt. We find here that across the board, 2-year college borrowers are actually have higher default rates. And in turn, we see also differences by the neighborhood race type, we find that the default rates are considerably higher for borrowers from majority Black neighborhoods than those of the other two neighborhoods. And in turn, it is actually higher, even higher, for borrowers coming from two-year colleges. So overall, out of these three slides that we just saw, we can see that there are considerable differences across neighborhood, race, across both borrowing and education. When we are looking at the racial composition of neighborhoods, it is typically the case that the attendance rates are lower for individuals from minority neighborhoods, whereas it is the case that default rates are considerably higher for individuals coming from the minority neighborhoods. Next, I'm going to move on to the next blog post. So as a result of the increasing tuition over years, decreasing state subsidies on state appropriations for higher education, there has been a lot of programs that are geared to subsidizing higher education. And a major component of those programs have been tuition subsidies. There has also been some instances of free college happening in different parts of the country, including in New York State, that was rolled out this year, actually, the Excelsior Scholarship. So in this post, we are going to look at a specific kind of tuition subsidy. These are merit aid scholarships that become available to students if they score within above a certain GPA in college as well as in high school. So we are going to look at merit aid scholarships because they have been in existence for a very long time, starting from 1991 to the present. And there are 27 states so far that have implemented this strategy. So we have quite a bit of variation that we can exploit to look at this question. So in this post specifically, we are going to look at the effect of college tuition subsidies on spending and debt, overall debt. So first, let's move on to spending, credit card spending. We are looking at credit card spending. Once again, we are going to distinguish between individuals coming from different kinds of neighborhoods as characterized by race. Let me first set this chart up. So you can see in this chart, there are three lines. The blue line is going to be looking at the average effect of merit eligibility on credit card spending. In other words, this blue line is going to compare credit card spending for merit eligible cohorts versus cohorts that were not eligible for merit aid. So, and the outcome is going to be credit card spending at the various ages from 18 to 30 that you see on the horizontal axis, and the vertical axis is simply going to be credit card spending measured in US dollars. So if you focus your attention on the blue line for a second, you see that individuals who are merit eligible or cohorts, merit eligible cohorts actually have higher credit card spending relative to ineligible cohorts in their early 20s. So if you focus at age 21, they actually are making $100 more in credit card spending than ineligible cohorts. This actually compares to, in an earlier post, we showed that these subsidies lead to declines in student debt borrowing, and this compares to a decline in student debt borrowing for $600 at the same age, that is age 21. So meaning like there is about a 17% pass through to credit card spending of the decline in student debt. What we can see is really a substitution between different forms of consumer debt because of eligibility for merit aid. These individuals face a lower net price. They are taking out less in student debt, lesser volumes of student debt, and accordingly, some of that debt is kind of substituted into credit card debt we see here. Now let's go on and move on to the gold line and the red line. So we are still looking at credit card spending. So what we see in the gold line is basically comparing the outcomes of eligible individuals from predominantly Black neighborhoods versus ineligible cohorts from the same neighborhoods. So here the definition of predominantly Black, and we also use low income, is slightly different than what we used in the previous post. Here we are going to basically look at the bottom fourth of the distribution, the zip code distribution of the corresponding outcomes, corresponding variable, and the zip codes that fall in the bottom fourth of the distribution of income will be called low income zip codes. And looking at the composition of percentage share Black, if we look at the top quartile or the top fourth of the distribution, that distribution is going to be called the predominantly Black neighborhoods. To be a little bit more specific, the low-income neighborhoods are neighborhoods where the average income is less than $24,000. And the predominantly Black neighborhoods are the neighborhoods where the average person share Black is 37%. So that's the kind of neighborhoods or zip codes we are talking about. Now, if we look at the gold line, what we see is that, once again, the merit-eligible individuals, merit-eligible cohorts from predominantly Black neighborhoods are more likely to have credit card debt in other work we find, and also larger amounts of credit card debt. And same is the case if we look at the red line. So basically what we find here is that we see similar patterns of substitution into credit card debt, but that which is much more prominent for low income and for individuals coming from low income and predominantly Black neighborhoods. This to some extent may be because of larger credit constraints in these neighborhoods, and it is possible that access to merit aid kind of leads to an increase in consumption in these dimensions, which otherwise would not have been possible because they would be taking out larger amounts of student debt. Now, moving on to the final slide for my part, we are here looking at card ownership or the propensity to hold a car debt, auto debt. And once again, we have three lines. The blue line is looking at the average effect. The gold line is looking at the effect on eligible cohorts from predominantly Black neighborhoods. The red line is looking at effect on eligible cohorts coming from low-income neighborhoods. What we find here, if we look at the blue line, is that eligibility leads to an increased propensity to buy a car as captured by auto debt. And if we look at the red line and the gold line, we see that these patterns are actually quite a bit more prominent for cohorts coming from the low income and predominantly Black zip codes. And it is worth noting that these patterns do not really really survive when we look at late 20s or early 30. And this is a pattern that we see for every kind of debt. And there can be many reasons that we are kind of trying to understand more now, explore more now. We also see higher default rates and higher delinquency rates in the earlier ages, which to some extent may be contributing to this. It can also be because these individuals or these cohorts are paying back debt at a better rate, which would also contribute to this, or they're taking out lesser amounts, or they're originating lesser amounts of debt. So there are lots of hypotheses that can actually explain the declines that we see in the late 20s, and we are trying to understand those better. And there will be more materials that we will be putting out later on this. So I'll stop here and then I'll turn this over to Maxime.
Thank you so much, Raji. Today I'll be talking about joint work with Paul Goldsmith-Pinkham and Jacob Wallace, who are now at Yale, and Paul was until recently at the New York Fed. And I'll be talking about the different ways in which Medicare affects financial health. We will measure financial health by the average amount of debt in collections which is a rather severe form of delinquency. It is debt that is more than 120 days past due and has been sold to a collections agency that then calls the debtor in the middle of the night to get them to pay. So it is a likely indicator of financial distress. The reason why we can obtain a causal effect of Medicare on debt and collections is that people become eligible for Medicare abruptly at 65. While the 60s are a time of change for most people, these changes tend to unfold smoothly over time, from retirement to downsizing, even to claiming Social Security. So we can look at the effect of becoming eligible for Medicare on various outcomes by comparing those outcomes for people aged just below 65 and just above 65. In the graphs above, we see that there's an abrupt discontinuity at 65 in insurance coverage from Medicare. This is in the graph on the left. Using the New York Fed's Consumer Credit Panel, which conveniently reports age, we see that while debt and collections declines smoothly with age, it jumps downward abruptly by about 30% at 65, and at no other age in the 10 years around 65. On the next slide, we see that more generally, using the very detailed geographical data in the CCP, we can compute the debt and collections just below and just above 65, not just for the US as a whole, but for each county individually. In the map above, darker colors indicate higher amounts in collections and hence greater financial distress. The map on the left shows these amounts for people just a little younger than 65, and the map on the right shows these amounts for people just a little older than 65, so those who just barely have qualified for Medicare. We see that while there's great disparity in debt and collections just below 65, with the Northeast and the Plains standing out from the Southwest and Midwest, this disparity shrinks dramatically for the just Medicare eligible, with the Midwest becoming indistinguishable from the Northeast and the South being much less of an outlier than it was for people who are just below 65. The variability in debt and collections falls by 2/3 with the introduction of Medicare. The size of the decline in debt and collections is different for different counties, with particularly large declines in counties with higher proportion Black, high poverty and disability rates, and large shares of for-profit hospitals. It is worth noting that the effect of Medicare on the distribution of financial health remains important in the wake of the Affordable Care Act, as the largest effects of Medicare tend to be in states that have not yet adopted the Medicaid expansion in the South and to some extent in the West. Our research shows the potential effects of universal programs in reducing geographic disparities in outcomes that ultimately matter profoundly to the macroeconomic health of our country. Thank you very much, and now I will turn it over to Andrea.
Thank you, Maxim. We're going to open it up for questions and answers. If you would like to ask a question, if you look on the lower right-hand corner of your screen, you should see a little hand sign. Please wave your hand and we'll call on you. And when you're done, please put your hand back down unless you have a follow-up. Thank you. Our first question is from Josh Mitchell.
Hi there. Can you hear me?
Yes, we can, Josh.
Okay, great. First of all, this is all great stuff. Thank you so much for doing this. I'm just curious regarding the student debt research. Is there anything that the research is telling us that could teach us something about what might happen during this current downturn? And I'm specifically thinking about how, 12 years ago when we were in another historic recession, there was this big boom in college enrollment, particularly at open admission schools like community colleges, that then led to a big rise in student debt. And so I'm trying to be a little forward looking here. What does this research tell us about what might or might not happen, or what are the risks of this cycle repeating itself? In other words, do you guys think the research tells us about whether enrollment in these colleges will rise again, and then will there be another increase in student debt, and then will there be another big default surge in student loans among disadvantaged populations? Just curious how this could inform us about what's coming ahead.
So these are excellent questions. So thank you so much for asking this question. And you were absolutely right that during the Great Recession, there were huge increases in enrollment in community colleges and for-profit colleges. And we actually have written about this in our LSE blog series. And there were, as you say, there were also large increases in debt, student debt, and defaults as well. So in this recession, we are actually looking at data, and we would have a much better answer to your questions if you asked us 6 months from now when we will have more data. So what we have been looking at, and there will be kind of some posts that will be coming up, are differences in incidence of forbearances. As you know, that there are different kinds of forbearances under the CARES Act that are geared towards student debt borrowers, mortgagors, etc. And we are trying to understand whether or not there will be racial disparities, income disparities in the extent of these forbearances and the amount of the forbearances. In terms of whether we will see another boom in college enrollment and student debt, it's something that data can tell. And I can definitely tell you that we are going to look at it. We are already assembling data to look at this. So the answer will probably be more informative a few months from now. We are starting to see kind of declines in state and local budgets, and that probably will continue. Again, we will be looking at all the data, and we will definitely be looking at the questions that you are that you have raised today. That's for sure, and more to come. So look out for the posts that will release on exactly the questions that you have just asked.
Maybe I can just follow up on Raji. So there are a couple of other considerations here. One of course, is whether people go back to college under the current environment with the virus. If it's not possible to do in-person attendance, that might affect attendance rates. Another issue is in a typical recession, there's more of a perception of permanence in job loss. And this is a recession where up to now, there's still a very high probability of a recall to go back to the job. So it also depends very much about what's going to happen on that front. So there are a lot of factors that are uncertain at the moment. So we don't know exactly what's going to happen to attendance. Like you said, in almost every recession, you see an uptick. So we expect that again. In terms of student loan defaults, that also is going to depend a lot on the permanence, or rather, how long the current programs that are in effect for forbearance, where everybody with a federal loan can apply for forbearance, whether that's going to extend beyond the current 6-month or 12-month period. So these are all kind of big unknown factors that are going to play a role.
Thank you. Just one follow-up question, and this goes to the idea that if you have more state subsidies, some of that debt might be transferred to credit card debt. One of my theories, but it's more than just a theory because I've interviewed a lot of community college presidents, was that the student loan program in some ways became a type of unemployment assistance program where a lot of unemployed workers enrolled in community colleges, in part because they needed some money to live off of. They were so desperate. Does that tie into your research on credit card consumption among populations that are enrolled in college? I mean, how much of that is just, because the social safety net isn't as strong as it could be, or any insights into that?
Sure. So again, another good question. So basically, we are not looking at unemployment, so we don't have labor market data. But what we do see that with these tuition subsidies, and again, we are looking at these merit scholarships, we do see that with these merit scholarships, because the net price kind of goes down, there are lesser student debt originations, lower probability of originating debt, and as you indicated, there is we see substitution into other kinds of debt, other kinds of consumption, and specifically we see a substitution into credit card debt as well as auto debt, so higher propensity to buy cars as well as have credit card spending. But it is true that there are differences across neighborhoods. Again, we don't see race; we see the race of the neighborhood that these individuals or the students are coming from. What we do see is that this particular pattern is considerably stronger for individuals coming from the predominantly Black or lower income neighborhoods. And it is the case that so that may be because, as you also indicated, because they may be more credit constrained, and because of this eligibility for merit aid, if they are doing less in terms of student debt borrowing, so they actually are they're doing less in terms of student debt borrowing, so they're substituting into other forms of debt. We do find, though, as you see in the charts, if you look at the charts that we just presented, they're also in the post, is that at the very end, overall debt actually does go down. And there may be, again, we are trying to understand the data, trying to understand, and you see in the post that is currently on the slide that is currently being displayed, here we are looking at one kind of debt, we are looking at credit card debt. We see that for total debt as well, total debt does go down. And there can be many different reasons why this can be the case. So this can be because we see the higher delinquencies in the early 20s, and more so for individuals or for cohorts coming from this predominantly Black and the low-income neighborhoods, that to some extent might actually lead to this, later reduced possibilities of borrowing. But also it can be the case that they are borrowing less. Maybe their needs are met, so they are borrowing less, or maybe they are paying back better. So that's why their debt is their debt in their late 20s and 30s are actually less than the ineligible cohorts. We are trying to understand this, but it is true that in the early ages, we do see some substitution into other forms of consumer debt.
Just to very quickly add to that, there is, like Raji said, overall debt is going down, and we see a very strong decline in student debt, even at early ages. So to the extent that the story that you were describing, that people using it as a substitute for unemployment, we actually see that in response to lower tuition, net tuition, they are lowering their student debt. If they wanted to use all of that for consumption, they could have done that, but they're not doing that. And the increase in consumption is also more consistent with people who, while in college, while they're working, they might use some of that money that they would have used to pay for college. They use it now for other consumption. So there's some substitution going on there.
Thank you. Any other questions? If there are, please use the hand at the bottom, right hand bottom. Raise your hand, and We'll call on you. Any other questions? Seeing no hands raised, would you like to make any closing remarks?
Andre, I'm going to assume you were talking to me.
Yes.
Well, thank you very much. I just want to thank everyone for attending. It was a good opportunity for us to talk to you about some of the important work we're doing on inequality and heterogeneity. And I want to thank the authors for the presentations. As I mentioned during my initial remarks, there are many more blogs coming up, some of which will touch on the subjects that were raised here, but also on a wide variety of other topics, many of which will be related directly to the COVID pandemic. And so I hope that you will keep your eyes on the Liberty Street Economics blog, and we look forward to talking to you again in the near future.
Thank you
With that,
all.
I guess.
Sorry, Andy. Thank you all. With that, you can all disconnect. Have a good day.